Okay, so good morning, everyone. Welcome to the macro snapshot for Wednesday, May the 7th, 2025. I'm also going to take a look, of course, at the Fed meeting, which is happening this afternoon at 2 o'clock. Okay, so first of all, let's have a quick look at what's going on. There was a couple of quite, big bits of information or news which happened overnight. Of course, the first thing was that there was the news that Treasury Secretary Scott Bessent would meet with the Chinese Vice Premier in I think it's Geneva in fairly shortly. I think it's on the 12th of May in the next few days. Now, at this point, this is only to set the agenda. So, as Scott Bessent himself said, they're going to talk about what they're going to talk about. So, they're setting the agenda. Nevertheless, the market has taken this as a positive, a sign that China and America both want to come to the table, and that this possibly could signal the beginning of some kind of trade deal. So, there's a couple of things to say. Actually, I'd say three things. The first thing is that yes, this is a positive because negotiation is positive, and the market reacted in a positive way. But the second thing is to say that this is going to be only a very I think it's going to be a complex and messy procedure, and it's going to take quite a long time to get any sort of outcome. And the risk for sort of for disappointment, I think, is quite high in the sense that any sign of a breakdown in talks or lack of progress, I think the market won't like that. And thirdly, which I think is sort of probably, in my humble opinion, the most important thing is that I think I showed it yesterday. Just even if, for example, the tariffs go down from some kind of ridiculous punitive level of 145%, if they go down to 15 or 12% or even just 10%, we have to keep in mind that this is substantially higher than what we've seen in these markets for the last, even going back to the 1930s, so almost 100 years. So it's going to be interesting to see how the market digests that, whether it's just going to be euphoria and say, oh my God, there's a trade deal. And then later it's going to take another sort of week or two or three or four or months for the market to say, hold on, but now we actually have substantial sort of universal tariffs everywhere. So, and so that's why it's interesting just to look at some of the market reactions. So, for example, I'm going to put on a 15-minute chart, so not too short term, not too long term. And you can see here that initially, let's look at a few market reactions here. And you can see that initially, gold, for example, sold off, but that has stabilized. Now, gold selling off, that's pretty sort of normal because one would have thought, less risk premium, et cetera, et cetera. But what's interesting is you go, okay, this must be amazing for copper because, this is all good news. But actually, copper didn't particularly love it. And then we look at, let's say, look at the yields, the US. So we look at the 2-year yield. So for sure, when the market opened, the yield did go up for example, on the 2-year, but it hasn't really ripped that much higher. So again, not really, a massive amount of optimism in terms of the future of economic growth there. Then if we look at just quickly look at a couple of currency pairs, for sure, something like the euro did. Actually sort of weaken on that. So the US dollar did weaken, but as you can see, the euro sort of gained back some ground. And if we look just overall at the dollar index here, you can see that the dollar initially popped, but basically it's given it back. And this is interesting because, one of the justifications for the weak dollar was, oh, global growth going down, lack of trust in the US, et cetera, et cetera. But as you can see, that didn't really last too long, that pop in the US dollar. It's basically just back down to those announcement levels. Also, let's say, for example, look on a trade currency, a proxy like the Aussie, we can see that the Aussie popped against the US dollar, but then actually sort of came back down again. So fairly muted reactions. And then just finally, just want to look at, let's say, the equities. Now, the equities did pop. For sure, then that's absolutely reasonable. And you look at the S&P 500 here. So again, 15-minute chart. So you see there was initial pop of I think about 250 ticks or so. But again, as you guys can see, it's come back down to like sort of a 50% retracement of that. Now, can that push up further today? Absolutely. But just putting this back on a daily, I think the point is to say that the market is still a little bit skeptical. Now, you can see here that, the market had been coming off. Again, this is when Trump announced, and I know I keep on talking about this, but I think it's important symbolically. This is the gap where Trump announced the tariffs. The market pushed higher. Got up to some, there's like 100 and 200-day moving average resistance up here, came down. And, okay, for sure, we had a little bit of a pop. But as you can see, we're not exactly getting up to the, 5,800 level above where Trump announced his the tariffs initially. So I think the point is the market is saying, okay, not bad. It's a good start, but the market is going to be very, very sensitive, as I say, to any snags, any hurdles, any disappointments, any lack of progress. And it's probably going to put a fairly high bar, I think, for progress. So the second thing which we got overnight, so I'm just going to grab some tea here. Course, originally comes from China. So talking about things Chinese, the Chinese at the same time as they announced that they would be willing to meet the US in Switzerland to begin trade talks, was the announcement of quite a lot of stimulus. So the People's Bank of China, the PBOC governor came out, and they're essentially going to cut the reserve ratio requirement. They're cutting the loan prime rate, adding a bit more liquidity. So essentially what they're trying to do is to cut some of the key interest rates, adding liquidity in various shapes and forms. So again, this for me doesn't seem to be absolutely transformational in terms of a massive, massive bazooka, but it's an attempt to kind of stimulate the economy, at least at the level of interest rates and liquidity. Again, did the market love it? Yeah, it had a little bit of a pop, but let's have a look at, for example, some of the Chinese equities. So we'll just look at some of the Chinese equities market. You can see here that the Shanghai 300, nothing particularly crazy. The A50 in China, nothing particularly crazy. In the Hang Seng, these are Chinese companies traded in Hong Kong. It did pop, but it's since faded. So as you can see, not a huge amount of confidence either in this China stimulus or the fact that the trade negotiations between the US and China are going ahead. Now, could that change? Are we just waiting for the Fed? It's all possible. So just kind of interesting there. Other thing which I just want to sort of catch up on is just what's been happening in Germany. We saw that yesterday, and this has always been a formality, there's a formal vote which takes place in the German parliament to formally confirm the chancellor, and it was expected to be Merz. But as we know, in the first round of voting yesterday, which has historically always been a formality for the last 50 years, he was actually rejected by about 10 or 15 votes. And that was sort of a symbolic signal by some of his coalition partners just to say, don't be so aggressive or abrasive or less inclusive. Who knows what was going on? Now, he was confirmed in the second vote, but still, what we have to try and figure out here, and it's kind of interesting just from a market perspective, is if he doesn't have full and unanimous support from his coalition partners, does that represent a danger for Germany's plans and the Chancellor's plans of actually pushing through more aggressive stimulus, infrastructure spending, defense spending? And we saw this morning a headline from Germany, from the defense minister, saying that he wants to immediately start off with a 60 billion euro increase in defense spending. Now, the reason this is interesting is just to start looking at some, like, for example, we look at the German stock market here, the DAX, and you can see that at a pretty critical level here. And initially on that news, which you see yesterday, is that spike of Merz not being immediately confirmed. It kind of spiked downwards a little bit, subsequently recovered, but still trading a little heavy here. So it's going to be interesting to see whether confidence in the German stocks and maybe Europe more widely. We'll look at the Euro stocks here. As you can see, not exactly popping. And again, that's interesting because we know that Germany and Europe in general, but especially Germany, is a massive exporter to China. So what happens in China is very, very important in terms of these markets here. So interesting to me that there's not more sort of excitement or optimism either on the China stimulus or the fact that Merz has been finally confirmed. We can also see that in the Bund, which I want to have a look at here. So we look at the 10-year Bund. Just interesting to see a reaction here. So what we're seeing here is that the Bund actually is having a little bit of a pop here. And is that sort of on the idea that, maybe the economy is not going to be as strong, there's going to be less stimulus spending, less infrastructure spending, and therefore less need to actually sort of issue long-term German paper. That's going to be quite interesting here. Let's see what happens here. Will this just turn out to be sort of a sideways consolidation, some kind of bull flag, and will the Bund actually sort of go higher? That's going to be something to be looking at. Also, of course, on the euro, as we were looking at, just in terms of what happened with Merz and China. Again, you can see that, I mean, the euro, we can't say it's not popping, and probably this is more a problem with the US, that the US, which has been absolutely destroyed by 5 or 6%, the US dollar over the last 2 or 3 months. This is maybe more of a sort of a bad news for US kind of situation. And, it does look as though the euro here potentially might want to pop out of this, sort of, bull flag kind of situation here. We shall see. Now that brings us to the Fed. So, sorry, I've got to A dusty throat. Okay, so let's look and see what's going on with the Fed situation. So first of all, there are no summary of economic projections. So I just want to sort of look and see what we've got here. So if you look at last time, hold on. So I just had a strange message here from Zoom. No, it seems okay. Okay, so if you look at last time, which was back on March the 19th, we can see here that the Fed is projecting only basically two cuts. Keep in mind that the effective Fed funds rate at the moment is 4.33%. This is a rounded number. So this is essentially the Fed themselves. The median was for 3.9% by the end of 2025. So only two cuts. So it's now quite interesting to see just how the market is, sort of positioned here. And let's have a look. And what we can see is, just literally this morning here before the Fed, we can see that by December, the market is actually projecting 3.1 cuts. Now, if you remember, that was actually up to about 4 cuts as recently as last Thursday. So that's been sort of a little more sort of less dovishly priced. But still, the market is still above the Fed. And we can see that if we look here on Bloomberg, the function, the dot plot function here, we can go here to the end of 2025. Now, this is where the Fed is. So you see the Fed here, which is the median here. These are all the dots of the Fed committee members. They're up here. Okay, so you can see the white line here. This is where we are with the Fed funds futures latest value. And as you can see, there's sort of a gap here. So essentially, according to the Fed, they are still more hawkish by at least a full cut compared to what the market is saying. So really the question here is like who's got to be right and what will Powell say? Will Powell kind of stick to this relatively conservative position and just say, hey, we need more data. There's a lot of uncertainty, and we're still projecting maybe only 2 cuts. Now, keep in mind, there isn't an updated SEP, Summary of Economic Projections, for this meeting. We only get it every second meeting, so we're getting that in the next meeting. But still, there's a difference between the market and the Fed. And it's actually pretty interesting to think that as recently as 4 days ago, this white line, which is the market pricing, was actually down here somewhere. It was actually 25 basis points lower. So the Fed at this point is being a little more cautious in terms of cuts. Now, we can also just see here the curve, how that's reflected. So this is the SOFR curve, which every dot represents 3 months. But what I want to put on here, just a couple of things. Well, actually, let's just want to put in something. So let's just put in the date before the last Fed meeting. Now that was on the 19th of March. So let's put it at let's say on the 17th here. And just to see what's going on here, you can see quite interesting little sort of movements. So what we can see is that this is now the live data is the white one. So you can see first of all that the terminal rate or the lowest rate is significantly lower than before the last Fed meeting. As I say, a week ago that was all the way down here. But at the moment it's at about where are we? About 3.1 or so compared to before the last Fed meeting. But what you can also see is how the market is doing this is that, interestingly enough, the market at the very front of the curve, so this is the next, sort of 3, 4, 5, 6 months or so, has actually put the implied interest rate a little bit higher, the implied yield a little bit higher. So it seems as though what the market is trying to communicate is to say that essentially for the next 2 or 3 meetings, the Fed maybe doesn't have to do too much. The real economy data will not necessitate the Fed being too dovish. But then there seems to be the market seems to be saying that what it expects is then for the Fed to be obliged to cut relatively aggressively, presumably because the unemployment data, which we know is the Fed's main concern, will actually worsen a lot, and also the real economy will worsen quite a lot. So it's quite interesting here just to see how the market perception has changed. And you can see here that that's clearly represented there. So another thing I just wanted to show you guys is just a couple of charts pulled up, and I have to say I have to give credit here to Bank of America. This is coming on sort of the Bank of America sort of research. And what's interesting here is that, as they're saying here, this is going back to the summary of economic projections from the Fed's last position, is that it's the most stagflationary risks on record. So this is kind of interesting, this diffusion index here. So what we have here on the x-axis is the core PCE. And you can see here that what the Fed was projecting was actually a fairly sort of elevated core PCE. So you can see here that the core PCE there, is very, very sort of elevated here to the right here. And yet you can also see in terms of the change in real GDP, it's actually low. So what we're seeing here is a lower GDP. See how this is sort of negative here. So -1% or -1 on it's a diffusion index. Actually, it's not a percentage. You see that's negative, whereas on the core PCE it's quite high. So this is a very stagflationary environment. And this is technically what the Fed was thinking at least, a few weeks ago. And what does that mean? That means here that they still have very considerable inflation concerns. So I guess what we're saying is that the Fed doesn't need and will not update its summary of economic projections this afternoon. It doesn't need to do that. It still seems to be very concerned about inflation. And I expect Powell to still consider to say that's an issue. On the other hand, they are a little worried about the real economy, but maybe not so much about the employment. So that's definitely stuff to be looking out for. Now, just in terms of a couple of other interesting charts, this one's a little bit. This is similar to what I just showed you on the Bloomberg terminal here. But basically, you can see here, this is where the Fed funds rate was, the orange one, just before their last meeting. This is pre-Liberation Day when Trump announced his tariffs, which is this sort of light blue. And you can see where we are today. So definitely, overall, the market at least is concerned about the effect of the Trump tariffs in terms of remaining inflationary, or whether it's actually going to sort of destroy the economy or cause a slowdown in the economy. And it seems to what the market is saying, which is a bit different to the Fed. The Fed is saying, we might get a slowdown in the economy, but we still have to deal with inflation. Whereas it seems that the market is a little more concerned that the slowdown to the economy should be considered a bit more of a problem than the sticky inflation. That's what the pricing is saying. Although, as I say, in the last few days, it has changed a little bit. And again, you can see a little bit here, just this is another way of presenting that data here, is just essentially see how the market, this is this sort of orange one is the May pricings for the Fed cuts across the next three meetings. So you can see that compared to, just as Trump was taking power at the beginning of the year, you can see here suddenly how, the market has become much, much more dovish in its pricing overall. And the real question is, which I'll get back to in a second, is will the market be disappointed? A, by the Fed, and B, by the real data, the hard data. What is interesting as well here, we have, this is quite an interesting graph. So you see here in the dark blue, this is the Bloomberg Economic Surprise Index. Now, what you can see here is that actually hasn't gone down that much. Now, what that's telling us is that the surprise index is essentially saying whether the real data is higher than expected or lower than expectations. So normally, as that goes sort of down, that is essentially saying that the economic data is coming in less good, less strong than expectations, which of course is kind of bad for the real economy. Now, is that sort of trending downwards? You can say from January to now, yes, it is trending downwards. But you could also argue that over the last 6 or 8 weeks, it's sort of going sideways and it's not collapsing. It's not collapsing. Now, what's interesting here is that if you then look at the SOFR interest rate pricing, end of 25 in the light blue, and the orange is kind of in end of 26, it's much more aggressively dovish. So again, what this is pointing to is that the market pricing for what the Fed should and could be doing is more dovish than what the economic data is really telling us. And this is really the gap. This is the key gap. And this is really going to be really what we all need to try and figure out, and what the market will be trading in probably over the next 4 to 8 weeks, to be honest, is essentially is one of these wrong? Does this pricing need to come back up because the real economy data remains robust, or are we about to fall off a cliff? And in fact, we haven't actually seen the true effects of the tariffs and the tariffs rhetoric yet. And will this economic surprise index, the dark blue one, actually really fall pretty hard over the next 4 to 8 weeks? And that, I would say, is what market consensus is. Another interesting thing here is just the dollar. Again, if we look here, what we have here in the light blue is the implied cuts cumulative of 8 Fed meetings ahead, which is about 1 year ahead. So essentially where the Fed will be, about 8 meetings ahead, about 6 weeks. So what's that, 48 weeks? So about essentially 1 year ahead. And normally, as you can see, the dollar which is the dark blue one, very, very highly correlated. So the idea here is that, if the market is expecting the Fed to cut more in terms of the rates, you see there's a negative value here. The dollar ordinarily would go down. But what we're seeing here is that the dollar weakness, the dollar has been a lot weaker than the implied pricing or the implied number of cuts of the Fed is. So this is saying that something has, again, kind of decoupled here, has sort of split apart, that the dollar is showing unusual, at least in terms of a historical perspective, unusual activity here. It's very, very weak. Now, is that just uncertainty? Is that a lack of trust in the US administration and US assets? Definitely something like that. So this is quite interesting here, just to see this decoupling. So that's it. So just in terms of market reaction, I think, the market is not really expecting a huge amount. The idea, I think, is that Powell will probably, the statement, I can't imagine the statement's particularly going to change much. And I think Powell will quite possibly try and do his very best to actually sort of say absolutely nothing. So really what the market wants to know is he going to take, we have to presume there won't be any sort of cut today because there's 0.0 priced in, as you can see here. But what is interesting, if we start looking out to June, there's, like technically a 1 in 3 chance of the Fed cutting according to the market. And then if we go out to July, there's actually almost a full cut is priced in, about 24 basis points. So I think what's interesting here is if Powell really just continues his rhetoric to say, what I'll be looking at is, okay, is he going to make any comment about the fact that China and the US seem to have started trade talk? Is he going to make any comments about inflation? If we actually look at inflation, oil has been more or less fairly muted. We know that sort of rents are starting to kind of stabilize a little bit. We've also seen in discretionary spending, things like sort of airline fares and hotel prices have actually started to go down. We're seeing that wage inflation is kind of sort of stabilizing a little bit. So it's going to be interesting to see if Powell sort of gives a nod today to inflation and says, well, inflation maybe is getting, it's not too sticky. There's still a lot of uncertainty. We are seeing some signs of cracks in the economy. So let's just have to see what he says. I don't think the statement's going to give anything away. They will, 99.9% not cut. So therefore, it's going to be all about the press conference, and that's what we have to look out for. What I think is interesting in terms of market pricing is maybe something like the July meeting, because as you can see here in the July meeting, there's a 24 basis points priced in for a cut. And the assumption there, I would say, would probably be what the market really is assumption, what's kind of assumed and in consensus at this point, is basically that the GDP wasn't too bad. There was a lot of front running of imports. Everyone kind of got ahead of the curve and started importing stuff and buying stuff to front run the tariffs. And then the idea is that, as we start getting more April and May data, like for that period, hard data, not the survey, the hard data will catch up to the soft survey data. And suddenly the real economy will see, less retail sales. We're going to see the unemployment rate go up and the initial jobless claims going up. And then the Fed will have to panic a little bit and will definitely have to cut 3 or 4 times this year, presumably starting in July. That's essentially the market consensus. So what will be interesting is to see what Powell says about that today, whether he's like, well, nothing to see here. We're just going to keep on waiting for more information. And of course, really what the market's going to be trading on is going to be signs of progress in the tariff talks, real signs of progress in the tariff talks, not just rhetoric, and also, of course, the real data. So that's it. So I don't expect huge moves today with the Fed, and unless, of course, Powell says something unusual that, he's starting to see signs of economic weakness and weakness in the unemployment rate. Just a final thing, guys, before I let you go. Is that we do have Besant today, the Treasury Secretary, at I think it's about 10 o'clock, if I'm not mistaken. He's speaking in front of the House Committee, and the subject is the state of the international financial system. So he's giving some presentations. That's probably going to be fairly technical. I assume that he's going to, just maintain that, the US Treasury market is very stable. But what could be interesting is that in the light of recent, very, very dramatic moves in things like the Taiwanese dollar and the Korean won, there's a lot of gossip and rumors that the Americans behind the scenes are putting pressure on some of these sort of countries in order to get a trade deal done is for them to basically allow their local currencies to appreciate against the US dollar, which would make the US exports more competitive. Some kind of Mar-a-Lago, Plaza 2.0 kind of accords. So it could be interesting today if some of the congressmen and women ask Bessent, are there any currency deals being done behind the scenes? Now, Bessent presumably would deny that and would, sort of say absolutely nothing. But he's a relatively inexperienced politically. Remember, he comes from the private sector. So you never know. Maybe Bessent will give a little hint today at this sort of congressional testimony that there are indeed some kind of sort of deals being done behind the scenes in terms of currency to try and get some of America's trade partners to let their currencies appreciate higher, putting downward pressure on the US dollar. Okay, guys, that's it for today. I've spoken enough. Let's keep the conversation going. Thank you and have a great day.